What if you bought index funds on margin just before interest rates started to rise in 2022? How would you have done? That's a thought I had, and I wanted to look into deeper and share with you here on YouTube. Now, I'm recording this on July 24th, 2025, and if you're at this video, I'm sure you know that interest rates have gone up rapidly since then, as you can see from this chart of the federal funds effective rate that I've got open on my screen. Prior to kind of early 2022, March 2022, interest rates, as measured by the federal funds effective rates, were damn near zero, 0.08%. And at that time, you could get a margin loan through Interactive Brokers for very, very low, below 2%. It was actually 1.58% for balances of less than $100,000 with Interactive Brokers Pro at that time, and 2.58% for balances of less than $100,000 with Interactive Brokers Lite. Very low rates at that time, and a lot of people, myself included, were looking at that going, hey, I could just use that money to buy index funds because that is so much lower than the expected rate of returns with index funds. And on that note, I have to say I'm a very big proponent of using margin loans as a financial tool. I've got a couple other videos on my channel talking about that, so you can check them out. And if you use margin loans as a financial tool, or you're considering using them as a financial tool, let me know in the comments below. Now, what I wanted to do was take a look at the performance of index funds and their returns versus margin loan rates, kind of in a quick and dirty fashion since interest rates started going up. So first interest rate hike was in March of 2022. And what I've done is I've opened up a Morningstar chart here set effectively to March 1st of 2022. You might see that that is 2/28. I'm using that date because these Morningstar charts are based on closing price data. That would effectively be the opening price on March 1st. And on here, I've got the S&P 500 represented by Vanguard's S&P 500 mutual fund, ticker symbol VFINX, and the Global 80/20 portfolio represented by Vanguard's Global 80/20 portfolio life strategy fund, ticker symbol VASGX. And since March 1, 2022, we can see the S&P 500 on a total return basis has returned 51.14%, a very nice amount. And the Global 80/20 portfolio has returned a nice amount, but not quite as nice as that S&P 500, 31.54%. So very juicy, but how does the interest rate actually factor into that? And to really get a rough estimate here, which is what I'm going for, of performance, we have to look at things in or on the basis of annual returns. So I used our good friend GPT here to calculate the compound annual growth rate of each one of these investments, S&P 500 and Global 80/20 fund. And we can see that over this time period, which works out in decimal form to 3.408 years, the S&P 500 had a compound annual growth rate of 13.56%, and the Global 80/20 portfolio had a compound annual growth rate of 8.87%. Both of these are above the interest rate at, their highest rates, or when they would have been at their highest here. Right, so that's most of, pretty much all of 2024. I guess they came down a little bit here at some point. But the point I want to make here is that the total return on an annual rate basis would have been higher than the interest you're paying for them over this time period. Now, one thing we really need to point out, though, is that through 2022, and then 2023, you were negative. So at this point, your portfolio has declined, and you're also paying interest on the debt that you would have to be holding the portion of portfolio or the index funds that you have on margins. This would have been a very painful period, but if you could hold through it, you would have had returns in excess of your cost of capital. And the other thing that would have to be considered here is taxes. Taxes are always a part of any investment decision. Never overlook them and never make any investment decisions without considering taxes, because taxes can really kill or haircut your returns. But in this case, with the margin loan, your interest is tax deductible if you're itemizing deductions. A lot of people overlook that if you're itemizing deductions because the common mantra is your margin interest is tax deductible. Yes, but that only applies if you are itemizing deductions. A lot of people are just taking the standard deduction, and therefore any interest expense they have really doesn't reach beyond that standard deduction. So you have to know if you're in a scenario to deduct it, but if you are, your interest rate here is effectively reduced by your marginal tax rate. So let's just say your marginal tax rate is 30%. I already did the math here, but if you did 6.83 times 0.7, reducing it by that 30%, your interest rate is effectively 4.78%. So you get a discount on that interest rate, and that really makes the annual returns here look juicy. So even as interest rates have gone up, had you invested in index funds using margin, you would still have pretty good outperformance over the last 3.408 years. I think that's pretty cool. I like seeing that. That said, we have to say that this is all hindsight looking. If you're considering using margin loans to buy index funds, well, you have to know that going forward, it may not be the same, and this is not financial advice. So, do your own research and make your own decision based on things that are applicable to you and your research and insight and your own intellect. Don't follow my guidance here, because I'm not in any way saying that I would buy index funds on margin. I'm just kind of looking at this from a hypothetical perspective of intrigue. But going forward, the index funds could, decline. You could go through a period like 2022 or 2023, or we could have 08, 09 crisis, right? Where there's big drawdowns. That makes things very painful. And when you're levered up through those drawdowns and through those periods of poor performance in the market, it is very, very rough. But at a simple level, over the last few years, while interest rates have risen and been high, you actually would have done quite well had you just bought and held index funds. On that note, guys, what is your take? Is there anything you feel like I missed out on here in this kind of review and research? Let me know in the comments. And if you found this video helpful or insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off on that note.